Coming up today, S&P 500 hits a new all-time high. Palantir continues to rally. Tesla robotaxi on deck, the latest from China. Hurricane Milton about to make landfall. Who HBO said created Bitcoin. And the bull market turns 2 years old. It's another good one, guys. Let's go. And welcome back, optimists, to your favourite financial channel, where your host actually trades and keeps a transparent track record for all his members. And what another good day for the bulls. Brand new all-time highs on S&P 500, 57.92. Are we going to get that big pullback or correction this month, like most people are expecting? Or are we just going to continue this parabolic grind higher right into the election? Or did CPI inflation data due out tomorrow morning already get leaked? Just looking at the VIX one-day index, option dealers not pricing in much movement tomorrow. It's only sitting just on a 15 handle here, which is pretty low. Market color looks rather bullish as well. Still got a little bit of a pullback up the front in oil, gold, and energy, along with REITs and utilities. However, we've seen tech jump out in front, along with blue chip stocks. Dow Jones Industrial also closing at a brand new all-time high. And stick with me today because I've got a few interesting things for you. Tesla robotaxi, what should we expect for inflation data tomorrow? And I'll also share with you billionaire Bill Gross's latest research he put out today, along with his favourite stocks. I'll also share with you a few other interesting stocks that may be taking a turn today, and I'll show you what my fundamental indicators are showing on them. Along with the latest from China, Hurricane Milton, oil, the Middle East. We've still got plenty going on this week. There's a look at the main sectors' performances year to date. Actually got communications now up front, up 25%. Keep in mind the communications ETF, 40% of it is just Meta and Alphabet. Very concentrated ETF, just like discretionary is with Amazon. Coming in second, tech and utilities. Actually beaten S&P 500 just by a little bit, both up 22% year to date. In fact, the best 12 months performance for utilities and the best year to date performance with S&P coming into Q4 this century and in an election year. And stick with me because in a minute I'll show you more stats on that, but just to get you updated on what all the trends are. Along with the rotations taking place now, just looking at my sector breadth table indicator, we really got energy and utilities pulling back up front and a big bump up in technology. Now the second best performing sector overall, second financials, that were also on the cusp of getting some key earnings out this Friday, JP Morgan. Third best performing sector overall, industrial. So overall we have quite a lot of bullish breadth, where it's mostly green in the long-term moving average. And so it's easy to see why there was a building narrative that we're going to see a pullback in October. Fear spike. Quite often get market events in October, and we certainly still might, as we're not even quite halfway through the month. And like I said, we've got the best rolling year-to-date performance of this century at this point of time on S&P 500. Coming into this volatile period hot, and it gets even worse when it's an election year. Typically, the indices will finish lower in the month of October in an election year. So is this time different? Are policymakers so supportive of markets that we actually may just grind higher into the election? And then we get the fireworks after that. As we're getting some fresh data coming in from Carson Research today, showing that when we make new all-time highs in the S&P 500 in the month of October, that typically bodes well for the entire month's return. In fact, 75% of the time we'll finish higher. Bodes really well for Q4. 90% of the time we finish higher. So like I've said before, there's nothing more bullish than an asset hitting new all-time highs. There's no resistance above it. It's clear blue skies. Really tough environment to short anything. Also got some research shared today by Michael Batnick. The forward 12-month S&P 500 total return when the S&P closes within 0.2% of an all-time high and the VIX closes above 20 is the current setup we've got now. Stocks at all-time highs, but the VIX pretty well bid here. However, this setup bodes well for the forward 12-month return. 90% of the time we finish higher, with an average return of 16%, that is really bullish. And the fact is, we've got global liquidity back on the climb. We've got global central bank easing, money supply increasing, and that quite often correlate with risk on asset like the stock market. And the master of hype, Jensen Huang's at it again. Working his magic on the market on the back of their AI summit in Washington, D.C., revealing a lot of collaborations and partnership all across the board with many industries, both public and private, and the market appears to be loving it. Nvidia shares up 25% in the last month, approaching all-time highs, as mega cap tech will kick off their earnings in a few weeks. However, Nvidia always comes later than the pack. In fact, their earnings are not due out for a little over a month. We're just pushing up against this all-time high resistance zone here, from about 134 up to about 141. We've previously put in some big bearish engulfing candles. The market's turned down off that, but we do have a lot of bullish seasonality, like we can see in my seasonality forecast indicator, just like I've been telling you guys all last week. And so typically when prices come up to highs, they can quite often pause and consolidate, retrace a little bit, but there's really no such thing as a triple or quadruple top, in my opinion. Prices keep pushing up against the top of a box, a resistance zone, the weaker it gets, and then we inevitably just slice through it. So I wouldn't be surprised to see Nvidia take out all-time highs in the coming days and weeks. And that is a good sign for this AI-led bull market. Semi starting to curl back up as a group as well. Not to mention the tech sector more broadly as well, taking out multi-month highs today. Technically good sign, and my seasonality forecast indicator is bullish over the coming weeks and months as well. And like I said, the utility sector, I think, just put in their best 12-month performance this entire century. Look at that parabolic grind in the traditionally defensive sector of utility. And that's thanks to the AI boom. Even though we're pulling back to the 50-day right here, this is in a really strong technical trend. Sector as a whole still yielding a little under 3%. And some of my favorites that I've spoken about on this channel for a year. NextEra Energy, which is heavily involved in renewables, also having a stellar year, but we're having a little pullback here in the short term. Still not quite technically oversold yet. See my DSI, still not into oversold levels. We're looking for some support once we get down there though. And that's thanks to the surge in power consumption from data centers. Looking at this data from Apollo here, and this is on last year's numbers as well. Sure, it's a bit higher now. Some US states, over 10%, even over 20% of their power consumption is going to data centers. And this whole AI boom is only about 2 years old. So I'd expect the colors on this chart to darken over the coming years. Some estimates are saying over 30% of the country's power consumption will be from data centers come 2030. That is a huge shift in the market for electricity and should provide a strong secular tailwind for those that provide it. And that's another reason why I'm so bullish on uranium. Nuclear energy, most efficient source of energy, and big tech is really starting to turn to that for their power need. And also to meet their emissions target. A lot of them want to be carbon neutral come 2030 as well. And so like we've been thinking, the AI trade appears to be back in full swing. Got the hottest AI stock this year, Palantir. Hits new highs. Been on an absolute rip. Just got news today they acquired shares in struggling EV startup Faraday Future Intelligent Electric, company with a market cap about 30 million. And so Palantir just joined the S&P 500 index last month, and it's already ranking the third best year-to-date performance amongst its 500 members. Nearing 100 billion in market cap. It's one of the largest software companies in the world and highly favored amongst a lot of investors, big and small. Some say this is the company of the future, really closely integrated with the government now, as a solid buyer, may make it a little recession proof, and they're at the forefront of this whole AI boom with all their platforms. They basically allow any company or government to plug in billions, if not trillions, of points of data into one platform that can then put it all together to give you really good data analytics so you can make better data-driven decisions. And that's why, even though AI big tech has stumbled for the last 6 months, Palantir's just kept on ripping. It's been coming out with some solid earnings beats, analyst upgrades, just been on an absolute tear this year. And in fact, it was the first stock pick for my new stock pick service that I started back in June. Currently up almost 80%, and that is no doubt upsetting a few people since it is highly valued. It's definitely not cheap, trading around 35 times sales. However, like I always say, technicals lead, fundamentals follow, and that's why we're getting the famous meme like that, someone throwing out their favorite value investing book into the garbage. However, instead of getting upset with what the market's doing, you can actually profit from it. And so if you'd like to get my weekly stock picks, then head on over to clickcapital.io. And I've had a few people email me after I did a promotion last week, 30% off a yearly plan, that they missed out on. So I'm going to reopen that for the rest of this week along with the indicator promotion. And I'm only giving out this coupon code on this video. So if you want to get 30% off a yearly plan to my stock pick service, then use coupon code PLTR. That's Palantir's stock ticker, and you can get 30% off a yearly plan. And follow my brand new trading account in real time, where unlike other trading memberships, I actually put my money where my mouth is and invest in all my stock picks the day after I send out my research to my members. So if you want to find out what all my current open picks are, get access to the private members area, along with my next stock pick this Sunday morning, then click the link below this video and use coupon code PLTR, and you can follow my investing account in real time as well. Just moving on, we also got cruise line stocks soaring up today after a bunch of analyst upgrade. Norwegian Cruise Line and Carnival, some of the best performing stocks out there today. Look at that, up over 10% on Norwegian. Royal Caribbean Cruise, up over 5%, which is pretty interesting price action to see in this type of market. We're getting plenty of news that the consumer's getting weak, but like I've been saying, cashed up baby boomers, a lot of them don't even really rely on an income. Inflation's not really affected them. They've got so much wealth in the form of assets that they've got cash to burn, and what they like to do is take cruises. And so like I said, money doesn't lie, the market doesn't lie. That was really strong price action coming from Royal Caribbean. But one of the biggest events this week is going to be the unveiling of the Tesla robotaxi. Elon Musk does have a lot to prove, big expectations. He's known for over-promising, setting really high hurdles and benchmarks for all his team. Is Tesla already going to be able to catch up to Waymo? A few others already offering fully automated ride sharing around some cities. How's the market going to perceive what they come out with. Will it get the market excited? But more importantly, what's the market's expectations of this translating into revenue growth over the coming quarters and years? Because there's one thing to hype it up, there's another thing to bring in the bacon. However, we've still got bulls out there like Dan Ives, who will be attending live for what he calls an historic event. He believes AI full self-driving represents $1 trillion of value alone for Tesla over the coming years. Big day ahead. So it has been hyped up a little bit. Now we're just waiting for the market's reaction to this hype. Can it live up to all these lofty expectations? And even though we were ripping up a bit over a week ago, kind of topped out a bit there. My reversal signal's firing off, and we've pulled back this week going into it. Seasonality a little mixed the next week or two. Actually got earnings coming out in 2 weeks. We just got deliveries a bit over a week ago, which they did beat expectations a little bit. The market seems to be kind of just on pause mode here. So we may get a big move either up or down out of this robotaxi event. So make sure you come back tomorrow and we'll break all that down for you. But on top of robotaxi, we've just kicked off Q3 earnings season as we're a few weeks into the new quarter. Got Bank of America saying the bar for earnings is low and stocks should rise as long as companies are feeling upbeat about lower rates. So these higher rates disproportionately affect some companies and industries more than others. I'm sure many companies, especially in real estate and other yield-sensitive sectors, are looking forward to lower rates. We'll also be looking for what their read is on the consumer and any commentary they have on the upcoming election. Just looking at FactSet estimates for Q3, if they come in line with expectations, this will be the 5th consecutive quarterly earnings season with positive year-over-year growth. We can see how much COVID distorted the year-over-year like it did with a lot of data. Corporate earnings went into a little bit of a recession in late 2022. However, they expanded back in 2023, and the forecast is they should hold up Q4 going into 25 and 26 as well. And just moving over to another big story in markets this week. China stocks, with the pullback continuing a bit today. FXI finishing down 1.62%. Did appear to be a little bit of a dip by action there off the open. Still obviously plenty of volatility out there. However, it was widely reported yesterday that China had its worst day since the global financial crisis in 2008. Some even saying it had its worst day in 60 years. Not sure where that data is coming from, because just looking at the China 50 index, it was down a little over 10% yesterday, which is pretty much the same move we got back in March 2020, 10% down day. However, look at the price action around that time. And then also back in 2015. We actually had a down day, 13.6%. But again, market was already in a downtrend, coming off a bit of a bull market. Hot run up, a lot of speculation, margin and debt. Authorities stepped in, cooled things down. But all that's just a technicality. Like I said, you can't look at one candlestick in a vacuum. You have to put everything in financial markets into context, as it's all relative. So even if yesterday was the biggest down day in 60 years, or whatever other people out there are claiming, like I said, I wouldn't call it a market crash, because in the financial community, a crash is widely defined as an index falling 20% or more in a very short period of time, like October 1987, Black Monday, S&P fell 20%. And so what people are missing is that we've also had the biggest market rotation, momentum thrust in Chinese stock history. So in other words, big rip, big dip if you're going to get fixated on daily percentages. So just keep that in mind, and it looks like I've just dipped down to the 50-day today. And just drawing a Fibonacci from this entire move, typically see markets make 50% to 65% retracements in between that 61.8 and 65, what they call the Fibonacci golden pocket. So we've already done a 50% retracement, and for sure we could have a little bit more to go. However, we'll just draw a support box where it dipped down to today, down to around the 65% retracement, looking for some support in this golden pocket. And stick with me, because I'm going to let you know in a minute why this dip may get bought and we could bounce back, even though a lot of people have gone back to saying China's uninvestable. And it's funny because we've got some of the biggest financial YouTubers out there telling you guys that China's in a recession, which I think is important to clear up, because if you're being fed wrong info, you may make wrong decisions. And so I'm not even sure if they know what a recession is. However, a recession is when a country's gross domestic product, kind of a sum of all its goods and services being produced, contracts for 2 consecutive quarters. So that's if GDP goes negative, which it did do in the first quarter 2020, like the rest of the world. Really sharp economic contraction and COVID. However, the fact is, and I know not everyone believes their numbers, however, they can be corroborated in many ways, even using data from other countries like Australia and what they sell to China. However, the fact is their economy just posted Q2 year-over-year growth in their GDP of 4.7%, and this is what they're worried about, because it has been coming down from the previously lofty levels of 7-6%, and so their government is trying to maintain 5% GDP growth this year. And so I think that's a popular misconception, that the Chinese economy is in a recession, when in fact it's quite far from it. Where their problems have been is more to do in their capital market, especially property. They overbuilt. Government also clamped down on speculation, more regulation, so developers just basically bailed. Way too much capacity, bondholders taken it on the nose, and their property prices have been coming down somewhat. And this is what they're looking to get underneath with direct measures for the market, loosening up conditions for mortgages and investors looking to turn things around, as a lot of Chinese have a lot more of their wealth and property compared to us Westerners. And so this is important for the Chinese to turn around. They've even come out and said they want to get property prices higher, along with their stock market as well. But looking at their unemployment rate, even though it's elevated compared to recent times, still not that bad at 5.3%. And they're actually grappling with deflation, right on the cusp of it, decreasing prices. And this is why I said sets up a potentially dangerous scenario for us here in the West, since we're still grappling with structurally embedded inflation, prices up 30-40% over the last 4 years. And then if the Chinese want to flood their markets to try and bring back inflation, that's only going to add upside pressure to global inflation, since they're the largest consumer of commodities and still the world's manufacturing house. We've also seen a bit of a decrease in their M1 money supply. Again, another big reason for them to really pump liquidity into their economy and markets, amongst other measures. But no doubt, many investors, small and large, will sell at the first sign of trouble. The first bad-looking candlestick on their chart, still got big selling from hedge funds. And just keep in mind, as a group, hedge funds don't perform all that much better than retail traders as a group. In fact, they underperform the S&P 500. There's only a few exceptions. Guys like David Tepper, Stanley Druckenmiller, and a handful of others that really beat the market over time. So when people hear hedge funds, they think they must be the best in the business, always beating the market, got inside info, all that. It's mostly not true. A lot of them are just private pools of wealth, mostly for the benefit of the owners. So no doubt the market is looking for more, just a monster run-up going into this announcement. And in my opinion, the Chinese wanted to cool things down. They don't want to see their market going vertical. Even before millions of new Chinese investors and those restarting old accounts can't get into the market. They don't want all us Westerners front-running their citizens, only for a big rug pull later on. But like I said, they really want to get underneath their capital market. They don't want to see their GDP slip below 5%. They don't want to see their unemployment spike. They don't want any social unrest. And so obviously there is more work to be done. Like I said, it's not going to be a walk in the park. Even if they do pull it off, it's going to be plenty of trials and tribulations, pullbacks, shakeouts, you name it. But like I said, if things get too bad again, they're just going to come out bigger and better. And in fact, we're just getting word that the Chinese Finance Ministry has scheduled a press briefing for this Saturday, October the 12th, on fiscal policy and economic growth. And that's what the market's really looking for, a big spending package from the government. And so no doubt authorities are watching their markets. And why when we got up here, if they did come out with a big bazooka fiscal stimulus, could have just shot to the moon and things were just going to get too crazy. So maybe they purposely threw some cold water on the markets, dialed it down a bit, as they don't want a whole lot of volatility in their market. Already shot up almost 50% in just the last month alone. So we've got 2 more trading sessions left in China this week. Today's Asian session on Thursday, tomorrow Friday, and they're going to meet on Saturday. That doesn't mean they're guaranteed to come out with their huge fiscal plan. Maybe it's another nothing burger. However, maybe this support zone does get defended 50% to 65% retracement. We very well may have a nice bounce here. If not going into the weekend, maybe next week if we do get some good news over the weekend. Because in my opinion, if markets start erasing all these gains and everyone starts saying China's uninvestable again, in my opinion, they're really going to pull out the big guns, especially if they've got millions of new Chinese residents just getting back into the market. But like I said, this is going to play out over months and years. This is not just a swing trade. It's going to go on and on. So as always, stay tuned in to Click Capital and I'll keep you updated on everything happening in the Chinese stock market. And like I said, I try and back up everything I say with the most accurate data possible. Moving on to Hurricane Milton, set to make landfall later tonight in America. One of the biggest hurricanes we've ever seen in the region. It's been mass evacuations, some calling it a 1 in a 100-year event that we seem to get every other year. Huge gas demand in Florida, now over 20 stations out of fuel. Apparently 59% of stations in Tampa, St. Petersburg, now out of fuel as well. Mass lines for supplies. Owners of catastrophic bonds, those that sell insurance policies on this stuff happening, similar to credit default swaps, which the buyer pays a yearly premium, typically 1, 2, 3, 4%, paid monthly or quarterly. Then if this event happens, and they get that 100% payout on the policy, of course, if the insurers don't take them to court and drag it out for years, like a lot of them often do. And according to Zero Hedge, losses from Hurricane Milton may reach $175 billion, making it the second most expensive hurricane in US history after Katrina, which was all the way back in 2005. Progressive and Allstate have the largest share of Florida home insurance market among major national players. There's the stock price of Allstate actually bouncing back today after Monday's sharp sell-off. Same story in Progressive as well. They actually report earnings tomorrow. It's going to be a big need for home improvement. Retailers already preparing. Going to be big renovations. This will go on for months as well. Still too early to quantify the exact economic impact to American GDP. Next month's jobs report, a few days before the election, will be interesting. And there's a look at the shares of Home Depot, which are also sitting at all-time highs. Big market cap now, over 400 billion. Moving on to the Fed, apparently there was a bit of a divide within over the size of the September rate cut. Apparently that wasn't just one lone dissenter, Michelle Bowman. Apparently a substantial majority favoured the larger half-point reduction, but some officials backed a smaller quarter-point cut. This is not what Jay Powell really led on at the presser. And when he was questioned on it, he pretty much just said people always disagree with him. He doesn't really care. He's just going to do it anyway. In my opinion, he bowed to pressure from the market and politicians. Because on a lot of measures, you could call it the softest 50 basis point cut in history. Just so happened to be done right in front of an election. Big coincidence, right? And now the bond market's starting to go the other way. Mortgage rates are climbing higher, along with bond yields. The bond market's starting to think, maybe the jobs market is okay. Maybe we need to start worrying about inflation again. So is it goodbye recession, hello inflation? Certainly a possible changing narrative looking across markets at the moment. We'll get another look at inflation CPI tomorrow, which I'd be very surprised if it came in hot. Everything that's happening now take a few months to filter through. I think that's why the Fed's timed it pretty well. The markets are on a sugar high for now, and we get all the bad stuff next year. And so that's what the market learned from those Fed minutes. But the stock market doesn't seem to mind. Got the 10-year rallying up again, 407. So these high yields don't seem to be pressuring stocks for the here and now. But like I said, this price action could be changing the path of the Fed easing cycle. With the market now giving 20% chance they may actually stay on hold when they meet early next month. And I'll be interested to hear Jay Powell's language and tone after the election, whether he starts talking about inflation again or not. Just moving on to commodities, still got some volatility in crude oil. Just got US crude supply data today, up a lot more than expected. Supplies and production flush across the world, and we're still waiting for Israel's response to Iran. Getting reports from the Wall Street Journal, US administration's frustrated by Israel's reluctance to share Iran retaliation plan. Looks to be a bit of a divide there in that alliance between the States and Israel. States wanting them to dial things down going into the election. Obviously doesn't look good if we're on the cusp of World War III, whereas that's not really Israel's priority as they're determined to win this war. And so it's still yet to be seen whether they target their energy, oil infrastructure, nuclear sites, leadership, and the crude oil market is undecided as well. Like I said, expect volatility, trading at $73 a barrel, with the oil VIX still elevated at 48. And like I'd been thinking for the last couple of weeks, gold was due a bit of a pullback here. This could actually extend further. Now we've got a little bit of bullish seasonality coming into it. We did get some reversal signals and such a crowded trade with so many people just starting to get bullish on it. And there's silver too, having a bit of a pullback. And let's move it on to Bitcoin. That HBO documentary came out and said that its Canadian programmer, Peter Todd, is the creator of Bitcoin. They gave some loose evidence, like a post on a Bitcoin forum in 2010, where Todd replied to a post by Nakamoto in a seeming continuation of the thought, as if he had accidentally made the second post from the wrong account. Shortly after that, Nakamoto sent his last email to the Bitcoin community in April 2011, saying he'd moved on to other things. Todd's account stopped post. And then just some other loose reason, like his previous resume claims he knows C++, which was used for the original Bitcoin code. I mean, that's a pretty loose association if you ask me. I mean, this whole thing's diabolical. A few years back, there was an Australian scientist who claimed to be Satoshi. So I don't really see any hard evidence. And the fact is, Peter Todd himself on X actually came on and said, I'm not Satoshi, which I believe him, but like many think, that's exactly what Satoshi would say. So who knows who it really is? And if the creator is even still alive, just kind of crazy to think. It's one of the largest assets in the world now, and we still don't even know who created it. And let's move on today to the latest research from Bill Gross, billionaire bond investor, posted this document on his website today. It's a bull market, you know, showing some bull market positives, job growth slowing but within normal historical ranges, China fiscal and monetary thrust, AI investment spending, potential productivity boost, lower inflation close to Fed target, war equals an increase in spending, momentum, Treasury 5 10-year yields, lowered by 125 basis points since the April peak this year, negatives, valuations, Schiller Cape, forward PE, Buffett's high cash position, the election, potential for higher corporate taxes, geopolitical tensions, may stunt global growth, forever deficits, and interestingly, he lists the same thing, momentum. It's a bull market, you know. So some of his favorite stocks, ALE, a utility buyout with 10% potential return next 12 months. And there's a look at ALE there, in which shareholders have approved a takeover offer, still subject to approval, but still trading at a 10% discount, which Bill Gross still likes. He also pointed to Master Limited Partnerships pipeline that offer 8% tax-deferred yields. NLY, a high-yielding mortgage REIT, and there's a look at NLY there. mortgage REITs never really quite recovered after the global financial crisis. And see, this has still got a dividend yield of over 13%. But like I said, look at that long-term monthly chart. Such a long bear market for these mortgage REITs. But who knows? Maybe putting in a monster stage 1 accumulation. Now over to a few other stocks, which some investors are saying are cheap now, like Celsius. One investor posting today trades at a lower multiple than Monster, looking at its enterprise value to EBITDA to sales and its revenue growth, 23% over Monster's 2.4%. And it's true, Celsius revenue is still significantly growing. So is their free cash flow, but the stock is significantly underperformed, but may be starting to form a technical base. My stock fair value indicator has it at $38 a share, and we're getting some price action that could suggest a potential base here. Just looking at my DSI indicator, we are getting a bit of a bullish divergence here. Bullish reversal signal just fired off today on a bit of a push up on momentum. Of course, these bases take a while to form. Back and forth, consolidation. Do have a lot of bullish seasonality coming in over the next few weeks. And it kind of reminds me of other stocks, previous high-flying growth stocks up until 2021. Zoom Video still got growing revenue, but it too showing some signs of accumulation. Big momentum thrust after their recent earnings. And another one, PayPal, which I think of as the bank of the internet. Revenue growing, still good value, good fundamentals. My trend candles just fired off. Bullish uptrend after it's been in a downtrend since late 2021. And again, good signs of accumulation. Now we're pushing up in PayPal. After it too had a good recent earnings quarter. So it's hard to believe some people out there still think it's just Mag 7 carrying this bull market. And I'm here to tell you it certainly is not. We have plenty of stocks rallying up now. And in fact, what I call the BlackRock barometer, key indicator of the health of the market, being the largest asset manager in the world, it too is pushing up on yearly highs. And this is really correlated with the health of the stock market since they make their money off AUM, assets under management. So the bull market's 2 years old, and I'd say probably the most hated and doubted bull market I've ever seen in my 20 plus years of trading and investing. Is this going to be one of the youngest bull markets to fail, or are we not even halfway through? What's your opinion on all this? Just over the economic calendar, a bunch of Fed speakers today and tomorrow. Jobless claims like we get every Thursday, but the big one, core inflation rate, 3.2% year over year, which I'd expect a 3.2, if not a 3.1, especially looking at the price action we got in stocks today, along with the volatility market, which like I said, option dealers not pricing in anything spicy tomorrow. Doesn't mean that's guaranteed not to happen, but they are mostly right most of the time. But the VIX is still a little bit elevated here, above 20. Things are still on edge a little bit. Even though the S&P 500 is not moving much at all, tracking at an annualized rate just above 10%. And at the end of the day, you can't argue with price action. All-time highs is the most bullish thing out there. And like I said, are we still going to get this big October dip most people have been talking about in the next 2 weeks? Or is the market just going to hold up into the election, which I'll just put a line on my chart for there, 5th of November. That's the election day. It's getting down to crunch time. Let's see what they feed us tomorrow in CPI, along with how the market reacts to Tesla, robotaxi, and then JP Morgan bank earnings this Friday. It's all happening here, folks. The AI trade appears to be in full swing. Let's see what tomorrow brings us. That's all for today. Thanks for sticking with Click Capital, and I'll see you all again tomorrow. Cheers.